It's a quiet Tuesday morning. You pour your coffee. You sit down at the kitchen table, and you open a letter from the IRS. Inside, there's a number you don't understand, a tax bill on your Social Security benefits, money you thought was yours, money you worked 40, 50 years to earn. Your hands start to shake a little. You read the letter again. You see the words, up to 85%. Your heart sinks. You ask yourself the question that millions of American seniors are asking right now. Are they really taking 85% of my Social Security check? And then you remember hearing on the news that Congress passed a new law in 2025, a law that was supposed to end the tax on Social Security. So why are you still getting this letter? If this scenario feels real to you, if you've been worried about taxes eating into the retirement you spent a lifetime building, I need you to stop what you're doing and listen carefully to the next 12 minutes. Because what I'm about to share is the truth. Straight from the Social Security Administration, the IRS, and AARP. Not rumors, not headlines. The actual rule. My name is Artur. I'm a senior policy analyst, and for years I've helped retirees just like you understand the rules that protect your money. Today I'm going to walk you through exactly what the 85% rule really is, what changed in 2025, and the 3 steps you must take to protect your benefits this year. And please, stay with me until the end, because there is one hidden mistake that thousands of seniors are making in 2026 that could cost them their full deduction. It's a quiet mistake. It's an easy mistake, and the IRS will not warn you about it. Let me tell you about Robert. Robert is 68 years old. He lives in Ohio. He retired 3 years ago from a job he held for 34 years. Robert is a careful man. He pays his bills on time. He keeps his receipts in a shoebox. He files his taxes every spring without fail. In early 2026, Robert heard the same news you probably heard. He heard that President Trump signed a new law called the One Big Beautiful Bill Act. He heard it on TV. He read it on Facebook. He even heard a neighbor say, "Robert, you don't have to worry about taxes on Social Security anymore. They got rid of it." So Robert relaxed. He stopped having taxes withheld from his Social Security checks. He took a large withdrawal from his traditional IRA to help his daughter buy a home. He cashed in some municipal bonds because he thought tax-free interest didn't count for anything. Robert did everything he thought was right. Then in April, the letter arrived. Robert owed over $4,000 in federal taxes, plus an underpayment penalty, plus interest. Robert sat at his kitchen table and cried. Here's the thing. Robert didn't do anything illegal. He didn't cheat. He just believed what he heard on the news. And the news got it wrong. So let me explain what actually happened and what the law actually says. The 85% rule comes from 1983 and 1993. Before 1984, Social Security benefits were 100% tax-free. Then in 1983, Congress passed the Greenspan Commission reforms. They made up to 50% of your benefits taxable. Then in 1993, Congress raised that ceiling to 85% for higher income retirees. Now here's the first thing you must understand, and please listen carefully. The 85% is not a tax rate. It is not a penalty that takes 85 cents of every dollar. The 85% number means this. Up to 85% of your Social Security benefit can be added to your taxable income, then your regular tax bracket, 10%, 12%, 22%. That's what determines what you actually pay. So if you get $20,000 in Social Security, up to $17,000 of it might be counted as income. But you don't pay $17,000 in tax. You pay whatever your bracket says on that amount. That's a very important difference. And most seniors get this wrong. Now, how does the IRS decide if you cross into that 85% zone? They use something called combined income. That formula is on the official Social Security website, FAQ number KA-02471. Combined income equals your adjusted gross income, plus any tax-exempt interest like municipal bonds, plus 1/2 of your annual Social Security benefits. Here are the thresholds. Write these down. If you're single, head of household, or a qualifying surviving spouse, Up to 50% of your benefits become taxable when your combined income passes $25,000, and up to 85% becomes taxable above $34,000. If you're married filing jointly, 50% kicks in at $32,000, and 85% kicks in above $44,000. And if you're married filing separately and you lived with your spouse at any time during the year, the threshold is $0. $0. Your benefits are almost certainly taxable from the very first dollar. Now here is the silent trap, the number that should make every American senior angry. Those threshold numbers, 25,000, 32,000, 34,000, 44,000. Those numbers have not changed since 1983 and 1993. Over 40 years, they were never indexed for inflation, on purpose. According to the Social Security Administration's own history page, in 1984, only 10% of beneficiaries paid any tax on their Social Security. Today, the majority do. Not because seniors got richer, but because the thresholds were frozen in time while everything else got more expensive. Now let's talk about the news you heard. The Big Beautiful Bill. The One Big Beautiful Bill Act was signed into law on July 4, 2025. It's Public Law 119-21, and I want you to hear me very clearly on this point. That law did not eliminate taxes on Social Security. I'll say it again. It did not eliminate taxes on Social Security. What it actually did, according to IRS Fact Sheet FS-2025-03 published on July 14, 2025, is create a brand new temporary deduction. It's called the Senior Bonus Deduction. It gives taxpayers who are 65 or older an additional $6,000 deduction on their federal tax return. If you're married and both of you are 65 or older, that's $12,000 combined, and it stacks on top of the existing extra standard deduction seniors already get. But there are conditions. The full deduction is available only if your modified adjusted gross income stays below $75,000 if you're single, or $150,000 if you're filing jointly. Above those numbers, it starts phasing out, and it disappears completely at $175,000 single or $250,000 joint. And here's the part nobody is talking about loudly enough. This deduction expires after tax year 2028, 4 years. Then it's gone, unless Congress votes to extend it. So the 85% rule is still alive. The IRS still counts your combined income the exact same way. The deduction just helps soften the blow for middle-income seniors. For 4 years. Now, you also need to know about the misconceptions that hurt seniors the most. First, many people believe Roth IRA money counts the same as traditional IRA money. It does not. Qualified Roth withdrawals are not counted in your combined income, but traditional IRA withdrawals are. So if you're planning your retirement income, this distinction matters enormously. Second, tax-exempt municipal bond interest is counted in the combined income formula. Even though it's tax-free elsewhere on your return, the IRS pulls it back in for this calculation. This is on the IRS Social Security Income FAQ page. Many retirees are caught off guard by this. Third, some seniors think married filing separately will lower their tax. In almost every case, it makes things much worse, because the threshold drops to 0. And because filing separately disqualifies you from the new $6,000 deduction entirely. So what can you actually do? Here are your 3 exact steps. Step 1. Set up voluntary tax withholding on your Social Security benefits. The IRS has a form called Form W-4V. It stands for Voluntary Withholding Request. You can choose to have 7%, 10%, 12%, or 22% withheld from each monthly Social Security check. You can also do this online through your My Social Security account at ssa.gov/myaccount. This single action protects you from owing a big lump sum at tax time. It protects you from the underpayment penalty under Tax Code Section 6654, and it lets you sleep at night knowing the IRS is being paid as you go. Step 2. Use IRS Publication 915 or get help from AARP Tax-Aide. Publication 915 is the official IRS document that contains the exact worksheet to calculate how much of your benefits are taxable. Most seniors don't owe the full 85% inclusion. Many owe far less. But you have to do the math correctly. If you don't feel comfortable with the worksheet, AARP runs a free service called Tax-Aide. It's staffed by IRS-certified volunteers. It is completely free. Go to aarp.org and search for Tax-Aide. They specialize in helping seniors with exactly this situation. Step 3. Plan your retirement income strategically before December 31st. This is the most important step. Once the calendar year ends, you cannot fix it. Look at your combined income. If you're close to a threshold, consider delaying a traditional IRA withdrawal or shifting some money to next year. If you have Roth accounts, use them strategically since they don't count toward combined income. And if you're 65 or older, make absolutely sure you are positioning yourself to claim that $6,000 senior bonus deduction while it still exists through 2028. Now here is the hidden mistake I promised to share with you, the one that's quietly hurting thousands of seniors right now. If you are married and you file your taxes separately from your spouse, you lose the entire $6,000 senior bonus deduction. The IRS fact sheet FS-2025-03 is crystal clear. Married couples must file jointly to claim this deduction, no exceptions. Some seniors file separately because of an old divorce arrangement, or because they want to protect themselves from a spouse's debts, or because a tax preparer told them years ago it was simpler. Whatever the reason. In 2025 through 2028, that decision could cost a couple $12,000 in lost deductions per year. That's $48,000 over 4 years, gone, quietly, with no warning letter from the IRS. If you are married, please review your filing status with a tax professional this year. It could be the most valuable phone call you make. So my friends, let me leave you with this. The 85% rule on Social Security taxes is not going away. The new law in 2025 helps some seniors, but it does not eliminate the tax. The thresholds are still frozen at 1983 levels, and the new deduction expires in 2028. You cannot wait. You cannot rely on rumors. You cannot trust headlines that say, "No more tax on Social Security," because they are not telling you the full truth. Please don't rely only on YouTube notifications to keep you informed. YouTube changes its rules all the time, and you may miss the most important updates. Subscribe to the official SSA email updates at ssa.gov. Bookmark irs.gov. Sign up for AARP newsletters at aarp.org. These are the sources that will protect your money. And if this video helped you understand even one thing better, please share it with another senior in your life, a neighbor, a sibling, a friend from church, because the only way we protect our generation is by sharing the truth with each other. I am Artur. Thank you for trusting me with your time today. Stay safe, stay informed, and protect the benefits you spent a lifetime earning.